Ladies and gentlemen, good day and welcome to the PDS Limited Q2 FY24 and H1 FY24 conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. From the management team, we have Mr. Sanjay Jain, Group CEO, Mr. Rahul Ahuja, Group CFO, Ms. Reena Joseph, Head Corporate Finance, M&A Investor Relations. I now hand the conference over to Mr. Diwakar Pingle from Ernst & Young. Thank you, and over to you, Mr. Pingle.
Thank you so much. Welcome everyone to the Q2 and H1 FY24 earnings call of PDS Limited. The financial results are available on the company website and the stock exchanges. Please note that anything said on this call that reflects the outlook for the future or that can be construed as a forward-looking statement must be viewed in conjunction with risk factors. This conference call is being recorded and the transcript along with audio of the same will be made available on the website of the company as well as exchanges. Please also note that the audio of the conference call is the copyright material of PDS Limited and cannot be copied, rebroadcasted or attributed in press or media without the specific and written consent of the company. With that said, I'll hand over the call to Mr. Sanjay Jain, Group CEO of PDS, for the remarks. Over to you, Sanjay.
Thank you, Diwakar. A very warm welcome to all of you for the Q2 FY24 earnings call. Before we delve into our quarterly and half-yearly performance, let me provide a quick backdrop of the current economic conditions and the industry outlook. The global economy continued to navigate through somewhat of turbulent waters. There is inflation around. We are through a geopolitical crisis in some parts of the world. And all this put together has created a bit of uncertain environment around us. However, if you look at some specific economies, the US witnessed growth in the third quarter that apparently was propelled by a resurgence in personal consumption expenditure. This recovery from a mere 0.8% to 4% rise compared to the preceding quarter is an indicator that consumer spending is beginning to show signs of revival, and therefore it somewhere has a bearing that maybe now there is beginning of positivity on the sector in terms of customer spend and therefore the retail sales benefiting from it. Turning towards the United Kingdom, this economy also has the global cues impacting in terms of inflation impact and notably in the clothing sector. Even though in the recent past there has been some marginal easing, Europe, on the other hand, presents a mixed bag with headline inflation demonstrating somewhere of a declining trend where the core inflation is persisting. A silver lining, however, is that the wage growth is catching up to the inflation and could be a precursor to a revival in consumer purchasing power, potentially giving a boost to domestic demand. Moving our attention to the fashion industry, predominant challenges such as inflated channel inventories, tepid consumer demand have continued to cast shadows somewhere in the first 6 months of this financial year. However, there is optimism now with signs of a demand rebound and also vendor consolidation at retailers and brands, and that is beginning to provide strategic tailwinds. To sum it up, while there has been an impact of the factors that I mentioned in the beginning on the demand, on the revenue in the first 6 months, we believe these trends are beginning to bottom out in various parts of the world, and as a result, we should see that the sector in general and companies specifically should start benefiting from it in the second half of the year. There is one more trend that, given the pain that has been somewhat there in the retail sector, there has been from a retail customer side an effort to let go a part of their value chain activities to credible counterparties, and that is where we believe that PDS should keep benefiting from this in terms of our order book beginning to be strong from the new line of activities that we started, whether it is brand management or sourcing as a service. So on the whole, we are positive about the remaining 6 months of the year, and we believe there should be a reversal of the trend that has been there in the last 2-3 quarters. Moving to PDS performance for the quarter, we have demonstrated resilience despite a challenging external environment. Though the demand pressures have impacted the top line, we saw a 13% increase in the gross merchandise value coupled with gross margin expansion. The increase in GMV is because of an improved service mix with sourcing as a service and brand management business, particularly Ted Baker, wholesale and design business, now being a decent part of our total order inflow. So when you see a 13% growth in GMV, whereas you are seeing a decline in sales, the GMV growth is coming in largely from sourcing as a service business, and these are pretty much long-term contracts, and as a result, slowly the company is building a steady stream of revenue, while the order comes in, and it actually gets built over a period of longer horizon as compared to the short-term contracts of design-led sourcing. We are further exploring and expanding our portfolio of brands and brand management services. Our subsidiary Poetic Gem in London recently acquired the intellectual property rights to design, source, and distribute the Little Mistress brand globally. We've also curated brands in collaboration such as Oh Me, Oh My for Tesco, F&F Clothing. We are expanding our brand licensing portfolio with the licenses of Snoop Dogg, Elvis Presley, Marilyn Monroe, and Snoop Dogg. Though the industry is going through a rough patch, we continue to evaluate our pipeline of strategic opportunities and long-term collaborations. We aim to capitalize on the prevailing market conditions, which present numerous assets at very lucrative valuations. So when I am touching upon the fact that there have been these opportunities around brand management solutions or getting some brands into our fold, we are sensitive to the fact that we will continue to pursue these opportunities wherein B2B shall be our focus area rather than we channelizing our energy in terms of our retail brand distribution. We want to capitalize on our relationships with other existing retail customers and see how we get B2B rights for various brands, whether we develop them in-house or we get a global license for some well-known brands. It is noteworthy to mention that even these turbulent times, our unique model consistently allows us to generate free cash flow operations, keeping our balance sheet strong and steady. In line with our dividend distribution policies, we have declared an interim dividend of 25% of the distributable PAT, which has resulted into 1.60 rupees dividend per share. Drawing from our track record of collaborating with industry experts, that's how PDS has been getting experts on board in its platform to pursue various new verticals that we are adding. We have onboarded Mr. Harold Tillman, CBE, as a global ambassador for PDS, and Mr. Mark Green on PDS US Advisory Board. Mr. Tillman is a renowned luminary in the British fashion scene and was the former chairman of the British Fashion Council with relationships spanning across continents and industries. Mr. Mark Green has been a leading professional in global supply and value chain operations over the past 23 years. Previously, he was associated with leading retailers and brands including Walmart, Victoria's Secret, and PVH. His focus will be on the North American growth strategy, representing PDS across industry forums and exploring new opportunities with US retailers and brands. To conclude, I believe there are reasons to be optimistic that the industry is turning the corner and we should beginning to see some growth from quarter three onwards. With this, I will now hand over to our Group CFO, Mr. Rahul Ahuja, who will take you through the financial performance for the quarter and for the first half of the year.
Thanks, Sanjay, and good evening, everyone. Coming to our financial performance, we reported a top line of rupees 4,578 crores for H1 FY24, with a gross margin of 20.4% for the half year ended September 23. As Sanjay mentioned, top line was mainly impacted by dampened consumer demand, which seems to be on the road to recovery as we speak. Despite the headwinds, we achieved gross margin of 20.4% for the half year ended September 23, an expansion of 394 basis points compared to H1 last year. This was mainly driven by better service mix with high margin services such as brand management and service fees from sourcing as a service business. EBITDA for H1 FY24 was 204 crore rupees with an EBITDA margin of 4.5%, an increase of 80 basis points compared to the same period of last year. EBIT for the first half of the year stood at rupees 173 crores with an EBIT margin of 3.8%. Last year's EBIT included gain from sale of real estate. If we normalize that income, our EBIT in H1 of FY24 has witnessed a growth of 8.4% with 74 basis points margin expansion. We continue to operate with higher interest costs, primarily due to increase in the base rate. Average SOFR increased from 1.42% for H1 FY23 to 5.14% for H1 of the current year. While the average limit utilization has decreased, interest costs have increased due to higher base rates of interest cost. Tax flow also increased by 5% as compared to the same period last year. One of the main reasons is taxability of companies in higher tax regions, mainly Ted Baker, which operates in the UK jurisdiction. As a result, profit after tax declined to rupees 112 crores, while we have maintained our margins at 2.4%. Moving on to the segmental performance, our sourcing segment, which comprises of design-led sourcing, sourcing as a service, and brand management, reported a top line of rupees 4,443 crores with an EBIT of rupees 165 crores. While our core existing business verticals witnessed contraction due to demand pressures, new verticals driving software as a service and brand management services delivered growth. Overall, the segment achieved a return on capital employed of 34%. Our manufacturing segment reported a revenue of rupees 214 crores with EBIT of 9 crores, margin expansion of 104 basis points to 4.1% compared to H1 of last year. As demand pressures ease, we expect this segment to grow in the coming quarters. With regards to the quarter, we were able to garner healthy GMV, which increased by 13%. Gross margins expanded by 496 basis points to 21.9%. EBIT adjusting for last year's real estate gain was up 17.5% with margins increasing by 140 basis points to 5%. Normalized PAT also expanded by 5% with margins expanding 71 basis points to 3.6%. Speaking of our balance sheet, you must have seen a slight jump in our net debt and working capital. It's important to note here that this was mainly attributable to the acquisition of Ted Baker, wholesale and design business. We completed the acquisition in the later part of June of this year by taking over the working capital, which mainly consisted of inventory, trade payables, and receivables. Currently, we are in the process of integration of this business and setting up the required bank lines, which will enable us to streamline the working capital requirements. Our agile business model continues to help us deliver strong 30% return on capital employed and a return on equity of 24% in the first half of this year. The Board of Directors have declared an interim dividend of rupees 1.5 rupees per share, a payout of 25%, which is in line with our dividend distribution policy. To conclude, we continue to evaluate and monitor the global markets and the demand scenario. Our model enables us to have the agility to pivot based on market conditions, which makes us believe we are well poised to capitalize on the unfolding opportunities. We are still cautiously optimistic about the demand scenario stabilizing in the second half of this year. With this, I'll request the moderator to open the floor for questions and answers from us. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question we've got from the line of Sagar from Samiksha Capital. Please go ahead, sir. Sagar, you're not audible. Could you speak closer to the headset?
Okay. Yeah.
Hello, Sagar. You're still not audible. I would request you to speak closer from the headset, or I guess there is a network issue. I think we've lost Sagar. So the next question is from the line of Mr. Aditya Java from AG Capital. Please go ahead.
Thanks for the opportunity. I have a question on the top 10 verticals. Firstly, if I see a Poetic Gem and the Twin Star and every 10 other joint ventures we have, the margins here are fluctuating from year on year if I compare quarter on quarter. So could you throw some light here? What are the sustainable margins for some of the top 5, if you can name them? That would be helpful. That is my first question.
Yeah, I think an average maintainable margin is 5% EBIT to sales ratio that we should see across the top 10 verticals. And some of them, for example, in Sri Lanka, which is operating in Sri Lanka, should be upwards of 7 to 8% because they are very close to the source and low cost of operation. Something like Clyder, which is actually also operating in Bangladesh, should also be upwards of 8 to 9%. So, and Poetic Gem at the same time, which is largely centered in UK, they should be getting closer to 5% or so. So on the whole, I would say if I just take design-led sourcing verticals, because given the size of Ted Baker, wherein we are trying to build 50 to 60 crore a month, that actually would clearly start coming under the top 10 verticals. But taking that vertical out, to answer the question, an average 5% PV to sales ratio is what we should be seeing across top 10 verticals.
Okay. Now, this is totally the sourcing as a service business, right? Whatever the top 10 verticals you have shared.
The top 10 verticals we have shared is design-led sourcing business, which has been continuing for many years. The sourcing as a service business is something that we started in the last 12 to 18 months in the Haynes JV in Bangladesh and also Asta. So that is not yet in terms of size in the top 10 verticals across. And there the margin profile, if I have to talk about that, for example, this year we believe we should be getting closer to from our 7,000 crore of the gross merchandise value, about 350 to 400 crore should at least get added into the top line of the company for the entire year. And on that, we should be getting somewhere closer to 18 to 20% PBT margin. So that's where, it is not yet in the top 10. That's a new line of activity. We've added 350 to 400 crore of annual revenue and about 18 to 20% PBT margin.
Okay. But the Ted Baker business is part of brand management, right? That is another vertical.
So yes, it is a brand management for now in terms of the segment within which we have reported. We have reported 3 segments, sourcing, manufacturing and others. So for now it is all clubbed under the sourcing segment. The sourcing as a service, the brand management, design-led sourcing is all clubbed under that segment.
So for this full year, what can be the Ted Baker total contribution? And for the next 3 years, what can be the total contribution?
As we have mentioned, that this is little about 3 months of getting Ted Baker into a fold. At present, it is generating 50 to 60 crores of revenue on a monthly basis. So therefore, to answer the question, if I take almost 9 months of Ted Baker into our fold, it should be somewhere around 500 crore, in terms of its contribution to the top line of the company. And we are on an average making 10% PBT margin. That has been a performance in little over 3 months that it is in a fold. And we anticipate that to continue. So 500 crore top line contribution, around 10% PBT margin. To give you answer to the second question that you asked, I think somewhere next year we are aiming at can be scaling up to 700 crore annualized, revenue contribution, and try and maintain or slowly augment the PBT margin from upwards of 10% to about 11%. So that's the outlook for next year.
Okay. So when you say income, it is not GMV, it is just the income or the gross profit you are saying?
So when I'm talking about this year 500 crore, this is actually the revenue that you will see the top line. For a Ted Baker business, there is nothing like a GMV. It is whatever is in my order book, it actually getting into my top line. The main difference that you see in a GMV and revenue from operations is sourcing as a service contracts, wherein, as we have said, $1 billion worth of contracts are in our fold. So therefore, answering the question specifically, the 500 crore aspiration from Ted Baker should be a revenue, and 10% PBT should be the straight addition to the PBT bottom line of the company.
My last question is on the broader perspective for 2 to 3 years or 5 years. When you say that we will, on a Concall level, will be 2.5, so basically 20,000 crores of revenue in some 3 to 5 years and 5% PAT margin, right? So this change, what is your short-term goal, like 3 years? That is my first question in that. And the second one is, in this mix change, how much the contribution will be coming from the new verticals? Because I think the new verticals will be contributing larger chunk to the PAT margin. So that is one Ted Baker that we understood, and there is Hinge, that is another part. And what are the other contributors currently we have, so that you are guiding that we will be reaching 5% PAT margin, because that is huge currently, whatever we are at current stage. Basically 3x PAT jump we are envisaging here. So I wanted to little color or deeper insights here. Thanks.
See, in terms of when we finished our financial year 22, we internally aspired, we did about 9,000 crore turnover that time. We internally aspired that can we aim to double. So that's where we set a goal that let's try and channelize our efforts towards a $2.5 billion, which is what you said, about 20,000 crore, and can be slowly inch to getting closer to 5% PAT. So now that is the goal that we thought we should all aspire for. And we felt that there are two new line of activities within sourcing as a service. And as we have clarified earlier, whatever is my gross merchandise value, 5% of that comes to my revenue. So on that 5% coming to my revenue, we had foreseen that in about 5 years, 8 to 10% of my top line may actually coming in from sourcing as a service contracts. That was one. And from a brand, whether it is a brand management, the way we described earlier, we believe somewhere there is a 5 to 8%, 8% plus kind of contribution that we anticipate should come in from managing brands. So that put together, these two new activities has a potential of getting 18 to 20% of our revenue that time. Manufacturing is about circa 5%, 6%, and we believe That is the way it should be in about 5 years. So that's the, answering your point on the broad breakup. I think it'll be tough to draw a picture, where are we in an intermediate goal. What is important is that, on a every 6 monthly basis, if not quarterly, we should be progressing in that direction. And somewhere the quarter 2 performance, seems to be reflecting that we are benefiting from the journey, wherein a better margin sourcing as a service contribution has led to better gross margins, and also our brand management has led to better gross margins. So that's, I would say, we are poised in the long-term goal, and I think you should see us making incremental movement in that direction.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Pallavi Deshpande from Sameeksha Capital. Please go ahead.
Yes, sir. Thank you for taking my question. Just wanted to understand again, just to clarify the numbers. So SaaS is, you're looking at it contributing to 350 crore to the top line. Is that right? 7,000 crore GMV?
I think the answer is yes. We have got orders worth about 7,000 crore annual GMV, and as we scale up it to its full potential, so somewhere when we exit this financial year, we would have, internally tried to scale it up to the entire, annual value clocking in. So therefore, by the end of the financial year of quarter 1, we should be in a position wherein we are having a run rate of it contributing 7,000 crore annual GMV and about 350 crore circa contribution to top line.
And in the first half, we've already seen 2,000 crores come in. So yeah.
Yes. I think in the first half, yes, one has seen that close to about 1,800-1,900 crore sourcing as a service has actually come in. So I think that if at all I mathematically double it up for the sake of argument, it's about 4,000 crores. But that's where I'm telling you that allow us another 2 to 3 quarters to scale it up to a level wherein the annualized value is actually about 7,000 crores.
Yeah. And so just I do that. Once I do the numbers there, so that's 100 crores of revenue contribution. Your numbers from SaaS in the first half.
Yes, that's broadly in place. That approximately that is the contribution, just about 5% of 1,800 crore. Yes.
Yes, and then 20% of that is the contribution to EBT margin at that time.
Yeah, I think as I said, that's the broad. Maybe Rahul can add here. That's the broad aim, that always 18 to 20%. But Rahul, you want to mention the exact?
Correct. Yeah, I guess like Sanjay mentioned. The range could be anywhere between 14-15% to 20%, depending on the contract,
right,
and at the point of time that you sign it.
And that's the PBT margin you're referring to?
Yes.
Right. So if I take this out, then the margin for the rest of the business seems, muted. If I do the numbers for the first half, I just wanted to understand,
Yeah, I think the margin profile, for example, we reported in say quarter 2 approximately 21.9% gross margin, and I think the main core business design-led sourcing has also given us close to 17% margin, gross margin, as compared to about 15% or so. While the sales have declined in design-led sourcing, but our ability to get better margins from the value chain we have been mentioning. So the better margin, to answer the question, the better margin position that we have achieved in the first half and second quarter is actually being contributed by all line of activities.
Right.
At the gross margin level.
Right. And so on the Ted Baker side of the business, so this revenue of 500 crores would be what kind of inventory turns are we looking at, and what's the kind of inventory we need to hold for that?
So in the Ted Baker business, if you would have seen, yes, our working capital has gone up, largely on account of our receivables and inventory periods going a little up, given the nature of this business. And talking specifically about the future, as this business stabilizes and we are able to establish, our working capital lines, which is the factoring line, this is likely to come down a bit in, let's say, a couple of quarters from now.
Just to add, let's just allow us to put Ted Baker in a larger perspective. We wrote a check of circa 160 crores approximately to get Ted Baker into a fold. We're looking at this year, in the 9 months plus period, about 500 to 600 crore of top line getting added and about 10% PBT. That's about 50 to 60 crore PBT is what we're looking at on an investment of about 160 crores to begin with. So that it turns out to be a healthy investment to begin with, given the PBT we expect and given the check we wrote. And now, as Rahul mentioned, PDS always aspires towards squeezing out the working capital optimally through operational efficiency and through uses of our non-recourse factoring lines. So we just got Ted Baker into a fold. And I think as we try and put these two tools into practice, with few quarters, we should also see that we try and bring down the net working capital in Ted Baker and thereafter improve the return ratios further.
So just lastly, because Ted Baker, I think revenues globally last year was around 4,000 crores roughly. I just wanted to understand. We would be exclusive suppliers for that business. For excluding Europe, I believe you would be doing it as a design-led servicing operation, excluding Europe. So does this full 4,000, do we at some point service the entire 4,000 crore of revenue of Ted Baker?
No. So 4,000 is the total revenue of Ted Baker as a brand globally. We only have a part of it, which is Europe and UK markets. The rest is by different stakeholders and parties who have tied up with ABG, who owns the license. As Sanjay mentioned, we are currently clocking about 60 crores a month in Ted Baker, which on an annualized basis takes this up to about 700 crores. We can expect a growth in the short to medium term of anywhere around 10% year over year on this brand. So that will be the contribution of Ted Baker in our top line.
I'll come back in the queue for further questions. Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Darshil from Crown Capital. Please go ahead.
Good evening, sir. Thank you so much for taking the question. Hope I'm audible.
It's not very clear, Darshan, but we'll try and understand.
Just a second, sir. Just a second. I'll just... Hello?
Yes.
Yeah, thank you so much for taking my question, sir. So just wanted to get a sense of guidance for our current year. I think you were mentioning about single-digit growth in the current year. What kind of, is that true, and what margins would we expect? Because with Ted Baker coming in, we should at least get a boost of nearly 500 crores with just Ted Baker, right? So how much growth are we expecting currently, sir?
Yeah, I think before I specifically answer your point on the full year guidance and the margin impact, I think there have been questions around Ted Baker sourcing and service. Just allow me to put everything in full perspective. Last year, we did about 10,500 crore top line. That's the last year number. Management is trying to see that despite the difficult times, can we try and get a low single-digit growth? And we have done about 4,600 crore top line in the first year. If I benchmark it to last year, that's about 40% of what we did last year. We have actually achieved in H1. Can we try and do 60% plus a small growth in the second half? I think if the global situation remains stable, it's doable. So that's putting things in a larger perspective. And another larger perspective, I wanted to share that if we did about 10,500 crore last year, aiming at a low single-digit growth, for the entire year, we talked about that 500 to 600 crore would come in from Ted Baker. We talked about, assuming we did 1,800 crore sourcing as a service contract in first year, we do circa about, say, 5,000 crore annually. I said we'll get to a run rate of 7,000. We're talking about 250 crore revenue, approximately that number. I'm just trying to put things in perspective from sourcing the service. And manufacturing could be about 500-600 crore full year basis. So we're talking about, approximately 1,300, 1,500 crore coming from these bunch of activities, wherein the gross margins are relatively much higher, as compared to design-led sourcing, which should be about 85% or so. So therefore, as we are scaling up these three line of activities, we should continue to maintain, leave the quarter-by-quarter movement apart. But I think we're heading in the direction wherein we should get our gross margin trajectory improving onwards. And secondly, the design-led sourcing, the main business, got impacted because of the global flus. And as we believe we are bottoming out, that should also fire back to bring the growth. So that's where I am, trying to answer to your question that we've given 40% of what we did last year is achieved in the first half. We believe we should aim for a low single-digit growth. That is number one, so that there is 60% plus in the second half of the year. And secondly, margin trajectory, I just spanned out the full year number or just for a hypothetical basis that this is what it is looking like. So therefore, the margin trajectory should continue to be healthy.
So thank you so much. That's a very detailed answer. So maybe, sir, if I can put it like this, sir, with the current scenario that our new initiatives are compensated for maybe the decline in our design-led business. So FY25 as a year, if things go all right, there'll be growth in our design-led business as well as growth in our newer verticals. So can we expect maybe both years compressed growth to come and some kind of higher growth rate than average in FY25? Would that be a great proper way to look at it? Would that maybe get us maybe more than 20% growth in FY25 and with our margins moving slowly towards 5%, so maybe around 3.5% in FY25 with the newer verticals contributing more? Is that a correct way to look at it, sir?
I would be guided by you here. If we all believe that sometime in the near term, this inflation is bottoming out, the interest rates, the Fed has refrained from increasing the rates further. If you all believe in about 1-2 quarters, the inflation is bottoming out, the interest rates are bottoming out, then I think from a year of FY23-24, which got impacted, and then next year is starting on a good note, getting into a healthy growth rate, yes, that's doable. I think, we all remain very positive that all these things in about 6 months should bottom out. So we are internally charged up, geared up, very positive that let's quickly put this year behind us and get back into a high growth rate year next year. And in the meanwhile, carefully adding more and more margin accretive revenue generating activities into our portfolio in line with the overall strategic intent.
Okay. So, sir, any in terms of numbers in FY25, high growth rate would be maybe more than 25%, and what kind of margin trajectory would be with our design led also coming back? So maybe some operating leverage in that. So any kind of a range would also do maybe around 3% if you can. So
I guess at this stage I can talk about the factors that should have a bearing on the growth. The factors are all beginning to look positive. In the next few months, we would be doing our annual budgeting exercise So somewhere when we get an opportunity to interface with you at the end of quarter 3 results, we would be in a better position to talk about what kind of growth rates we are looking at. But for now, I can say is we are very positive that there should be good growth next year. Specific numbers, just kindly bear with me till we interface again at the end of quarter 3.
No worries. So I think no worries. Thank you so much, sir. Most of my questions have been answered. Thank you.
Thank you. The next question is from the line of Mohammed Patil from Care PMS. Please go ahead.
Am I audible, sir?
Yes, please.
Yeah. Can you give us the rationale for the QIP of 625 crores?
Yeah. The motivation to look at this is twofold. On one hand, we believe this QIP should help us in further institutionalization of shareholding of the company. It should also help us further strengthening our balance sheets. These are two motivations on one hand. And at the same time, I think as we have been mentioning earlier, there are a lot of growth opportunities ahead for us, wherein retailers are looking at complete sourcing solutions to be given to companies like PDS. There are companies looking at us to handle exclusive geographies like 2 contracts we signed Asta and Haynes. Similar to Ted Baker, there are more such opportunities to be pursued for complete brand management. And the word has, when I say word, I'm keeping the customers in mind. There have been a conversation around nearshoring, and therefore, we have set up our manufacturing in Bangladesh and in Sri Lanka. While we'll continue to be asset light, but to a small extent, should we look at a manufacturing in Egypt or in India, for example, originating from India, we believe there should be good prospects. So if I bundle up all these opportunities, the PDS is, facing, it's a nice situation to be in, that there are a lot of immense growth opportunities around us. So it's because of these twin objectives, the second bucket of objectives of the growth that I mentioned to you. In fact, interestingly, things like brand management or sourcing as a service, we are also now witnessing inquiries coming in from Indian retailers, that can we now support their back-end activity. The model that PDS has been trying to build and pitch to our customers is receiving an acknowledgement by the Indian retailers as well. So therefore, being positive about the growth, we feel a suitable capitalization of the company by way of an equity would enable us meet the 2 bucket of objectives that I just mentioned to you.
Would this go towards reducing the gross debt or investing in working capital for the new businesses that you mentioned?
I think it's broad-based. Of course, from a theoretical perspective, as soon as the money comes in, the first thing you do is you try and reduce your debt. So it's pending utilization, and allow me to use a phrase, this equity should enable the balance sheet. PDS has been trying to navigate its balance sheet to keep it asset light, low leverage, and therefore it should enable our balance sheet to pursue these growth opportunities with a lot of confidence. That's how I would, seek your liberty to put it.
So we already have a very strong balance sheet for that matter. My second question is, can you please give me the GMV SaaS contribution to top line and PBT for FY23? Just wanted to understand the base.
I think there was a question earlier as well, wherein we had mentioned that in the GMV, we have in the second quarter close to about 1,800 crore, coming in from the sourcing of the service. So if we annualize it, it's about 4,000 crore as in terms of GMV of the sourcing and the service contracts, but we should keep improving it. So assuming we are just repeating our first half, then we're talking about 4,000 crore and at about circa 5% we are looking at minimum 200 crores, but upwards of that coming in as revenue from sourcing as a service operations into our overall revenue bucket. This was the question I was asked earlier as well, please. Yeah.
No, I wanted to get this number for FY23.
23 was minuscule. I think, it was less than about 600-700 crore in terms of the, sourcing as a service GMV that we handled. So if I apply the same 5%, then we would have just got 25-30 crores into our top line from sourcing as a service last year. Sorry if I misunderstood. I thought you also asking about FY24.
Okay, and this 25 to 30 crore, 18 to 20% to PBT. That stays same, right?
Pardon me, repeat again, please.
On this 25 to 30 crore top line, the contribution to PBT will be 15 to 20% for FY23 as well.
Yes, that's right. Yes.
Okay.
These are broad estimates that we are giving to you, but it should be around in the same vicinity.
Okay. What is the potential of Gary Weber for FY24 and beyond?
We just took charge sometime in September, October, and if I count 12 months from here, we think there is a potential to do about 700 crore plus of annual handling of sourcing for the customer. That will be billing through us. So that's what we're looking at. 700 crore is the annual value, starting effective the second half of this year.
Okay. And last question, what should we take as ETR for FY24 and beyond?
Rahul, do you want to answer? The question is on effective tax rate that we should be taking 24 onwards.
So, effective tax rate will marginally inch up, given that, we have the likes of Ted Baker operating out of UK. So I would say, maybe a couple of percentages it will go up in the next financial year. But post 25, there is the global minimum taxation coming in, which is 15%. So, we should be closer to that.
Okay.
2 years from now.
Thank you.
Thank you very much. The next question is from the line of Akshay Chheda from Canara Robeco Mutual Funds. Please go ahead.
Yes, sir. Just one question from my side now. Since the things are gradually improving, sir, how do you see the retailers placing their orders? Is there a change in their style of working? I mean, are they little more cautious while placing orders, or they are just the way they were working previously also? Just on the retailers, how are they working out? So just if you can comment on this. Thank you.
I think the retailer is more cautious now. So therefore, they are closing orders as much close to the date that they can hold on. Everybody is wary of not allowing themselves to get again into a situation of high inventory. So therefore, it is taking a little longer time for the orders to come in. And the retailers have also slowly been, kind of squeezing their global span of office spaces. For example, the retailers earlier were having active offices in the region, and they are collapsing them and taking it back to the head offices structure so as to keep the cost low. So therefore, taking more time, trying to go back to more decision making in the head office. And number 3, now the retailers is beginning to see value in a company like PDS, wherein they can take responsibility on behalf of retailer for sourcing. That's why one is seeing increasingly more traction of sourcing as a service contracts or sourcing solution contracts. So the third is a more structural shift that is happening, and the first and second is a more responsive shift, immediate responsive shift of retailer to the current situation.
And so, on the sourcing side, is it that this China Plus One is happening? Are you seeing that for other geographies except China? Are they preferring, say, India or Vietnam or Bangladesh. So do you see that also happening?
Yeah, I think that's also happening as well. Whether the motivation is China plus one,
Okay.
or the motivation is nearshoring, therefore reducing the lead times. So as a result, yes, the other locations, as I mentioned earlier, Egypt, for example, Turkey, while the costs have been rising in Turkey, but still there continue to be good, strong interest in sourcing from Turkey. Sri Lanka and India are also benefiting. Bangladesh is also benefiting from a China plus one scenario. So two factors here, China plus one and the nearshoring. And I think somewhere, when government in India is paying a lot of attention to Make in India and giving a lot of benefits to manufacturing of garments, that is also improving the attractiveness and ability of the Indian manufacturer to be able to meet the global demands.
Understood, sir. This was very helpful, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Sagar from Samiksha Capital. Please go ahead.
Hello. Am I audible?
Yes.
Hello.
Yes.
Yeah, sir. So my question was, as we know that textile industry as a whole has a demand subdued, and that's why our design-led sourcing has a higher gross margin. Do you think that once the demand comes back, our gross margins will reduce?
There are a few factors that always have a bearing. Yes, in a scenario wherein there are lesser orders, so therefore our ability to sit across, the factories and get a better margin, yes, that ability exists. 12 months back, all of us were adversely impacted by input price increase in cotton and yarn, which has now been at a low level. So therefore, the demand has a bearing on the ability to get better prices. The input prices have a bearing. And the third thing, which is specific to our company, is that are you able to get the benefit of size and scale? At the end of the day, you are somewhere procuring commodities when it's come to cotton and yarn or fabric. So therefore, when we are, very humbly getting bigger in size, our ability to then get better prices. So combination of these three things. But in a silos, I have to answer the question. Yes, a strong demand the benefit that we got in the gross margin, a strong demand should lead to growth in sales. The margins could be again a bit on pressure, but then I think on a portfolio basis, our other engines are already beginning to fire in terms of sourcing as a service, in terms of complete brand management. So I wish there was one single factor correlated, but there's a mix of factors that would. But on a silo basis, yes, stronger demand may mean that somewhere a benefit that we got on margin may a little bit wane away.
And so my last question is that as we know that interest rates are increasing, so our account receivable factoring with financing cost is higher. What would be our strategy on this front?
Sorry, I didn't get your question. Could you repeat that?
Like our financing costs, high, right? So what will be our strategy on that? Will we still continue with account receivable factoring?
So, we need to understand what constitutes our debt. Our debt is working capital, right, which is trade-based. And currently the interest rates are at an all-time high. In due course of time, maybe let's say anywhere between 2 to 4 quarters from now, if there is a downward trend, given that this is largely working capital linked to market benchmarks, and if there is a downward trend, we should stand to benefit from a reduced, rate of interest on an absolute basis. Given the growth that we are projecting, yes, if you talk about a number, it will, increase in line with our growth. But if you're talking about the percentage to sales, as interest rates come down, the interest should come down for us in the payment.
Thank you so much. That's all my time.
Thank you. The next question is from the line of Madhur Rathi from Counter Investments. Please go ahead.
Thank you, sir. Sir, I just wanted to understand why would a client shift from design-led sourcing to sourcing as a service, and what kind of benefit does it have by onboarding us as a sourcing agent?
Sorry, what's the last sentence? What kind of benefit?
So what kind of benefit does the client will have for onboarding us as a sourcing, providing us the sourcing segment of his operations?
So if I get your question right and try and answer it from the lens of a customer, wherein they have been using our services for design-led sourcing, and wherein customer feels that while they would keep engaging with PDS, keep taking their designs and therefore keep placing orders, they've also been dealing with many other factories. They've also been having their own office in Bangladesh or in the other parts of the world. They don't want to run, those offices. They want to bring down their cost structures, and as they do that, they were looking at credible counterparties. So therefore, they are looking at now PDS to run those operations. So this new sourcing as a service is in a way helping me get a larger share of wallet of the customer. And the other thing is that a design-led sourcing is for me is like, I'm designing and I'm taking the complete responsibility. I'm acting as a principal. But in a sourcing as a service, I'm running the office of the retailer. Any factory who wishes to do business with the retailer, while they will bill it directly to the retailer, but I am the nodal agency managing that traffic. So therefore, I would say just to put numbers in perspective, I was trying to handle, say, 60-70 million plus of design-led sourcing for Asta as my customer. That is the business I was doing. Now they have given me another contract that we were providing 400 million, from the eastern region. Can you please run our office in the eastern region, and manage this 400 million worth of procurement? I said, okay, I will do that. And that's where circa between 3 to 5% I get. So it's an additional wallet share.
So in future, is there a demand, is there an outlook where most of our design-led sourcing, there will be few that will get converted into this high margin segment for us? Better margin.
These are for us, we would always aim them to be mutually exclusive. And in fact, in response to one of the questions, we had said that at the end of FY22, we aspired that can we aim for doubling ourselves. And then I said that even at that period of time, close to 80% plus of our revenue would keep coming in from design-led sourcing. And it's about 8-10% that would come in from sourcing as a service. So it would be a new line of activity which is being scaled up, but our main core business of design-led sourcing will continue to be exist and thrive and grow as well.
Okay, sir. Thank you, sir. That was very helpful and all the best.
Thank you. We take this as the last question. So I would like to now hand over the conference over to Mr. Sanjay Jain for his closing comments. Please go ahead.
Thank you, Nuvama team. Thank you, ENY, to help us coordinate this call. And thank you, ladies and gentlemen, for participating. And we have a lot of festivities ahead, Diwali, and wish you all and everyone at home happy Diwali. And we look forward to connecting with you at the end of Q3 and the earnings call thereof. Thank you and stay safe, all of you.
On behalf of PDS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.